My name is Dave Zapponi. I'm the CEO of ECHO, otherwise known as the Educational Council of Homeowners. I want to thank you all for participating in the fourth annual Ask the Expert about Experts About Insurance seminar. ECHO is a statewide nonprofit association established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and networking. For this event, I ask that you please mute your mics and turn off your cameras during the general sessions. Thank you very much for that. For today's event, we have a few housekeeping items. These are now presented on the screen. This slide deck was sent to all registered attendees prior to today, but please take a moment and review our housekeeping items. You'll find those on the screen. Today, we have a large audience of HOA board members, more than 200. In lieu of our normal Q&A session, we have a format that allows you to ask your questions directly of the insurance companies in the breakout rooms. So you'll be able to ask them and they'll be able to answer your questions. Today, we have a couple of presenters and premieres. The Heritage Bank of Commerce is also going to be in our breakout room sessions. Please use the chat feature to report any technical issues and to communicate directly with other participants in the webinar. At this point, let me direct your attention to your monitor where you will find our disclaimer. Very important. None of what is said during this seminar shall be construed as specific legal or expert advice from the speaker sponsors or ECHO. If you wish specific advice, we encourage you to contact your attorney or another suitable expert. The information we provide during this webinar is educational in nature and should not be relied upon for specific decision-making purposes. Thank you all, and we appreciate you understanding and respecting our disclaimer. This webinar and all of our events are made possible by the generous support of ECHO HOA professional service providers. Please join me in thanking today's premier sponsors, Heritage Bank of Commerce. Our program sponsor is George Peterson Insurance Agency, and our registration sponsor is Silver Creek Association Management. Breakout session sponsors, we have 4 breakout sessions that are sponsored. Each represents an HOA insurance agency or brokerage, and all will present educational information during our 2 general sessions today and be available to answer questions during the breakout room sessions. Our breakout session sponsors include the Kevin Boland Insurance Agency, Socher Insurance Agency, Spina Insurance Agency, and Labar Oxney Insurance. Our premier sponsor, Heritage Bank of Commerce, will join the insurance companies with a breakout room. Now we will hear a few words from our premier sponsor, Sonia Lopez, with the Heritage Bank of Commerce. Sonia?
Hello, everyone. Good afternoon. My name is Sonia Lopez. I'm with Heritage Bank of Commerce. Oh, yeah, it displays, but the slide here just says everything that we do. We've been in the business for 30 years. I've personally been in the business 20 years. We are a specialty HOA bank. We have a dedicated team, customer service team, a dedicated team of relationship managers and operations. And we do HOA deposit services, HOA reserve investments, HOA special assessment loans, full service integration, and we are also a consultative. We take the consultative approach. That word's hard to say. Basically, we take the consultative approach and try to figure out what the problem is and help you through that process. So glad to be here today and look forward to the breakout rooms.
Thank you so much, Sonia. We appreciate the Heritage Bank of Commerce. We appreciate the services you provide to the HOA community and to ECHO, since you're our bank as well. And now to learn about today's presenters, Kevin Boland with the Kevin Boland Insurance Agency has been a successful farmers insurance agent since 2002. His agency is based in Novato, California. Kevin has three important industry credentials: the LUTCF, or Life Underwriter Training Certificate Fellowship, the CIC, Certified Insurance Consultant Credential, and the AIC, or also known as the Associate in Managing Claims Credential. Mr. Bolin graduated in 1984 from the University of California at Berkeley. Kevin regularly writes articles for Echo Journal and gives HOA insurance talks. He manages the insurance needs of more than 45 HOA homeowners associations, from 4 homes to 400. Kevin also served on his board of 214 homes. He understands and rewards the rewards and challenges of serving large HOA organizations. Charlotte Allen has been with Socia Insurance Agency since 2005. As Director of Education and Industry Partnerships, Charlotte works collaboratively with agents to highlight Socia services, knowledge, and dedication to their clients. Her commitment remains focused on educating common interest developments and their community leaders on some of the most prevalent and challenging issues facing HOAs today. Welcome. Christy Spina from the Spina Insurance Agency has been with Farmers Insurance since 2006, originally learning the insurance industry from her father, who opened the Marin County Agency in 1984. Today, her agency specializes in common interest developments and has worked with over 500 HOAs all over the San Francisco Bay Area. She was also a founding member of the Echo North Bay Resource Panel. Welcome, Christy. And Bridget Tabor is with Labar Oxney Insurance and has been a licensed agent for more than 20 years. She started her insurance career in the healthcare industry. Prior to becoming an insurance agent, she spent 20 years working for several large, long-standing law practices in San Diego in areas of construction defect litigation and employment matters. She now specializes in property and casualty insurance with a focus on common interest developments and the construction industry. So we have several really fabulous presenters today. So we're going to go into our general session, and then after that, we will break into our breakout rooms. So let's go ahead and start with Kevin. Go ahead, Kevin. Take it away.
Okay. Hi, everyone, and thank you for attending today's insurance webinar. This will be my 4th year participating, and I'm super excited about today. We have a lot of great speakers. So my job today is to talk about 3 topics. One is what happened in the last 3 years that all of our homeowner associations' insurance rates have skyrocketed 3 years consecutively. What happened? Because in the last 25 years, we did not see this kind of result. And number 2, what are the underwriters and all the insurance companies going to be doing differently next year? And number 3, and probably the most important in all of our minds, what's going to happen to our rates? And I'll give you my prediction at the very end. Okay, next slide. Unfortunately, I put up this slide the last 3 years. And one of these years, I'm hoping I'm going to turn that frown upside down. But like a lot of you board members out there, you realize it's been a tough year for all of us. So I'm going to keep this one here until we can rectify it. Next slide. Thank you, Connor. All right, so the major reason that our insurance rates have gone up so dramatically is because of catastrophes. We have hurricanes, we have floods, we have tornadoes, and of course we have wildfires. On top of that, we have a lot of convective storms. A convective storm is basically a thunderstorm, but it's not at the same intensity that a major hurricane is or a tornado. However, the frequency of convective storms has gone up dramatically too in the last couple of years. And even though they're small ones, cumulatively, they make a big difference in the insurance costs. Of course, when we have catastrophes, we have construction inflation. It's been up about 40% since 2020, most people believe. And what we don't often think about, but some of the same insurance companies that insure your single-family homes and our homeowner associations, they also insure your auto. and auto rates have been going up dramatically too. So this also impacts the company's bottom line. I just read something last week that since the COVID, the number of fatalities and the number of expensive auto accidents has risen like 30 or 40%. And nobody can explain why, but it's been happening to us, and that's been a big driver of costs. Social inflation means attorneys, personal injury attorneys, are suing more often. They're actually fishing, as we all know, for customers today. Some of these claims, I'm sure, are legitimate, but a lot of them are frivolous, and that's making our rates go up for liability. And then the older buildings. As we all know, most of the buildings for HOAs were constructed in the 1970s, so they're getting older. So if you're in an association that's in an old building, pay close attention to what Charlotte and Christy are going to tell you today, because they're going to give you some good tips on how to maintain your buildings. And then finally, the high cost of reinsurance capital. Global markets, wealthy individuals and wealthy institutions provide reinsurance money. So they collect a little bit of premium from your premiums that you pay to the insurance company, the primary company. In exchange for that, when all of a sudden there's major catastrophes like we've experienced, the reinsurance companies come in and they actually help pay the claims. No one insurance company can actually cover the broad exposure we have today of catastrophes. And that's why it's really smart and it's important to have reinsurance companies. Even the California Fair Plan, as you'll see, had reinsurance companies to help it out during the LA fires and afterwards. Okay, next slide. My favorite graph, because it shows how many billion-dollar losses have occurred in the last 10, 20 years. And you can see the average billion-dollar loss about 5 or 10 years ago was under 10 billion. The average has gone up dramatically. So in 2023, when the last time I could really ascertain good data, the number of billion-dollar claims has gone up to about 28. So that's $28 billion claims in 2023 versus about 16 billion in 2015. So the graph makes a big statement. Next slide. So here's a terrible pic of the LA fires. We all know they were recent. Who expected to have a major wildfire in January after Christmas? Yet it happened. Next slide. So the LA fires, we had 30 civilian casualties, 37,000 acres burned, 18,000 structures destroyed, 45 billion in estimated cost. And I know that's going to go up because, as we all know, the estimate is always a lot less than the final invoice that we get. And then what we don't often think about is the tax loss. So when you lose a lot of homes and a lot of businesses in a geographical area like Los Angeles, all of a sudden you lose the tax base. So the local municipalities, they're going to be impacted negatively, affecting the school districts, the roads, and all the infrastructure. And also the federal and state lose their tax base as well. So a lot of economic losses are tied in with a wildfire. Next slide. So a little bit of good news here that I just heard yesterday, as a matter of fact, that farmers in AAA, and I'm sure a lot of companies are going to follow, they've stepped up and they're going to give a check for 75% of the LA homeowners of their personal property coverage. And the homeowner does not have to provide inventory or write down a list of all the personal property in their home that they lost. Who can do that? None of us. So it's been a really smart move, and I'm really proud of AAA and farmers for doing that. I think other companies are going to follow suit. They normally do. Farmers and AAA are based here in California, so they're typically the first ones to step up. I'm calling out Liberty Mutual, State Farm, and Travelers because they haven't done it yet, and I think they should do that. So we're waiting for you guys. Okay, next slide. And we can't forget the Maui fires. It's amazing how devastating they also were. Next slide, Connor. $6 to $8 billion in losses, over 100 lives lost, 2,200 structures destroyed. I discovered during my research, though, there is some good news, some silver lining here. Last year in 2024, Maui had 2.35 million visitors, and they spent $5.27 billion in tourism. So I'm glad that this island is going to make a comeback. It's my favorite island in Hawaii to attend to. So some good news there. Next slide. What you're looking at here is, and we often forget about this hurricane, even though it's only been about 7 or 8 months, Hurricane Helene in September 26th. You're looking at the satellite photo of the Hurricane Helene as it enters the Gulf of Mexico. This caused a lot of damage. Next slide, Connor. Believe it or not, $78 billion in economic losses from this one hurricane. It's the costliest hurricane since Katrina in 2005. And Katrina was about $120 billion. So this is a serious hurricane that just occurred recently that's going to impact insurance companies' rates for the next couple of years. 250 fatalities. And then my brother actually was hit pretty hard. He lives in North Carolina. 750 million in losses just in that one state alone. Okay, next slide. Thank you, Connor. So when is hurricane season, FYI? Well, how about a couple of days ago? It runs from June 1st to November 31st. Mid-August through mid-October, the highest risk of a hurricane. So you might, excuse me, you may want to be careful when you make your travel plans there. And a hurricane has sustained winds of 111 or more miles per hour. Okay, next slide. So the 2024 hurricane season, which is going to impact our rates this year and next. The Atlantic hurricane season saw 18 named storms. And if they give a name to your storm, it means it's a big storm. 11 of those were hurricanes, over 111 miles and sustained winds. And 5 were major hurricanes with sustained winds over 111 miles per hour. Some of them were 150 miles per hour. Okay, next slide. All right, so the big question on everybody's mind is, what do you think is going to happen next year with the insurance rates? Well, the reason I wanted to show you, the Helene hurricane and the Maui fires and the LA fires is because they're going to have a dramatic impact on the rates. So your rate is really going to depend on how big your homeowner association is, how many buildings, how much property coverage, because the property portion of your bill, if you're a homeowner association, is the largest part of your bill. So it's going to depend on your size, your geographic location. Are you in a low, medium, or high wildfire zone? And a third variable that the insurance companies are using today is, what is the concentration of homeowner associations and homeowners in your zip code or your city? So for example, if you have, let's say you're a moderate, not a high, but you're a moderate wildfire risk, but your particular company, let's say Travelers, Farmers, or State Farm, has a heck of a lot of associations and homeowners that they're insuring in your city or in a couple of zip codes that are close to each other, you are at risk for being non-renewed, and or your rates are going to go up, in my opinion, and it's only Kevin's opinion, but 25 to 30% on average. Some will be a little bit higher, some will be a little bit less. Now, if you're a small association, you're in a non-wildfire zone, you don't have any claims, or maybe one small claim, I don't anticipate your rates going up more than 5 or 10%, which is what I've seen this year, because you're in that nice spot. Also, if you are a newer HOA, if you have a fire sprinkler system, if you have hardy plank siding, which the insurance companies love, then you can expect your rates to, I would hope, stabilize. The insurance companies, they rarely lower their rates unless they're super profitable, which is not happening right now. So I would hope that if you're in that non-wildfire zone, you have no claims, your rates are going to stabilize. Now that's my crystal ball. If you're small, you might go up about 5, 7, or 10% because of construction inflation. But if you're large, you're going to go up higher. What could change all this is if we have a high frequency of convective storms again this year, if the hurricanes, the tornadoes, the floods, the wildfires, they can happen again. We just started our season. We used to say the wildfire season in California ran from June through November. Now, as we know, it's any month, any given day. And also, I didn't mention this earlier, but the tariffs by our new president, they also are going to affect the cost because we get a lot of our materials and supplies from China, other countries. Canada actually last year gave us about 29% of all the lumber that we use to rebuild in the country. 29%. So I'm hoping our new president doesn't touch that one. Also, the insurance companies invest like we do as individuals. So if there's a poor performance year, which because of the tariffs, the markets are a little bit in turmoil right now, that also is going to impact rates. And then guess what? The California Fair Plan is anticipated to raise rates as well. I made some notes here, and one of the reasons we're going to see the Fair Plan go up in rates is because they had to pay out an estimated $4 billion in the LA fires, particularly the Eaton fire and the Palisades. And the California Fair Plan, they also have reinsurance companies that help them out, but it wasn't enough to cover the risk and the damage. So what the Fair Plan is doing now is they're asking insurance companies to pony up $1 billion to help them get out of the mess that they're in. And then, as I said a minute ago, I'm anticipating their rates are going to go up too. How much? I couldn't say. It's too difficult to figure that out, but I do think they're going to go up. And just FYI, in the LA fires, Travelers Insurance will pay out $1.7 billion. Farmers Insurance is going to pay out about $600 million. Excuse me. State Farm is the biggest auto and home insurer in the nation. And they had a lot of market penetration in LA. So they're going to pay out the most, which is estimated to be, get a load of this, $7.6 billion. That's a huge amount of money. State Farm was already in financial trouble, and they've already pulled out of California. So I'm expecting a lot more of that this year. And then Chubb, who's an insurance company that really specializes in high-end homes, they have to pay out $1.5 billion. So a lot of bad news here for the insurance companies. But when they tell us that they're not making money, they're telling us the truth. Okay, next slide. All right, so what do we expect the insurance companies to do this year? Well, they're going to raise rates. Talked about that already. I've read in my insurance journal that the D&O policies have increased in frequency, or the lawsuits have increased in frequency. So we're anticipating a small increase of 5 or 10% in that, according to Swiss Re, which is a think tank for the insurance industry. Non-renewing HOAs in high wildfire zones, multiple claims. If you have small property claims and you can afford in the budget, or you can pull some from the reserves, pay those claims, because you want to keep your claim record as squeaky clean as possible under these difficult challenges we have these years. If you have multiple claims, you're at risk for being non-renewed, and your rates are going to go up. In a little better case scenario, you're not non-renewed, but your rates can go up dramatically. Okay. Let's see. Okay, I think next slide. So the insurance companies were allowed by our insurance commissioner, Lara, to now use predictive modeling, which incorporates artificial intelligence, applied science. So now they're going to be looking at a tremendous amount of variables to look at how much they're going to price your particular homeowner association. Fuel, ignition sources, topography, historical fire behavior. The age of the buildings, get copper pipes if you don't have them already. Credit scores of the owners and the tenants. The ratio of tenants to homeowners. And then the IoT, or Internet of Things. The IoT is a new term out there. It means that a lot of information can be gathered from large databases, either on mainframes or the cloud or somewhere else. And then you have specialized software programs that can pull all that data together and give a prediction to the insurance underwriter what the risk is for your association to catch on fire in a wildfire zone. It's a new area, and for the first time, this is what I call the X factor, because it could help you out if the predictive catastrophe underwriting says you're going to be safe. It could be a really good plus. But if the converse is true and you're in that medium to high wildfire zone with a high density of customers in that area, it could be trouble too. So anyhow, this is something that I wanted to share with everybody about it, because it's the X factor. Who knows what the predictive modeling is going to do for us? Okay, next slide. All right, I always have to give, as many of you know, I've been advocating for a bare walls policy for 3 years now, for a lot of reasons. it's a smart way. For those of you who might be new to the board, a bare walls policy simply means that the homeowner has to use an HO6 policy to pay for their interior fixtures after a major fire. So the association's insurance will bring in and build up a new building, new roof. They'll even come in and paint the sheetrock inside your home, but they won't pay for the kitchen, the bathroom, the flooring. They won't even pay to paint the sheetrock. The homeowner has to pick up that bill themselves. So that's what a bare walls policy means. Next slide, Connor. It's going to add something. There we go. So what are the benefits of a bare walls policy? Well, you save 20% a year. And if you're spending $200,000 a year, that's a big, big number to save. Also, most of my claims are water claims inside homes. So why not let the homeowner pay for that claim with their insurance? And then lastly, it's a long-term strategy to mitigate future insurance rate hikes, because if you have a clean record, especially now in these times, you're much more likely to be kept by the insurance company, and they're going to want to insure you. So I think it's a great idea. I'll be in the breakout room later, so if anybody has any more questions about the bare walls policy, because I've transitioned a lot of my HOAs to this, and it's been working out really well so far. So thank everybody for letting me give my insurance advice to you today. I'm looking forward to hearing some more speakers, and I'll talk to you soon.
Okay, Charlotte.
Hi, everyone. Can you hear me okay?
Yes, yes.
All right. Thanks, Kevin. I'm Charlotte Allen with Social Insurance, and I'm going to be talking to you today about managing risk by maintaining the homeowners association. When Dave and Connor asked me to talk about this subject, I also went ahead and added the benefit of also obtaining insurance through managing risk. So, common sense tells us, of course, we want to avoid loss. We want to manage risk for various reasons. But number one is safety, life safety. This is first and foremost above anything. But also these days, it can keep you insured. Oftentimes with the standard insurance market, which we'll talk a little bit about, it can keep some of your insurance premiums more steady. I don't want to say decrease, because I do agree with Kevin when he mentioned he doesn't see insurance rates necessarily coming down. And if they do, it would mean that the insurance companies are once again profitable. But I think that we've got a while to go before we see anything like that. But certainly keeping them steady would be nice. And really, it keeps your association, your business running as is, meaning if you're avoiding loss, you're keeping homeowners and tenants inside those units, you're keeping the association running as usual. So of course, we want to mitigate loss, avoid that risk. Next slide, please. All right, so Kevin went over kind of the history that brought us to where we are right now, and what's changed for you as homeowners associations and boards that are running them. Well, you've certainly seen the premium increases. I made a note that Amy mentioned in the comments that their association premium went from $73,000 to $583,000. That's 8 times the premium that they were paying previously. So I know for a fact a lot of you are feeling that same or similar pain to Amy and seeing substantial premium increases, which we'll also talk about. We've also seen carriers exiting the market. So we've had insurance carriers that have been here in a very lucrative California market for many, many years. And all of a sudden in the last few years, we've seen those insurance carriers exiting or saying, you know what, we're going to take a pause and we're not going to insure, any new policies for a time being. So that's certainly been new for our industry in the last few years. You've also seen non-renewals. So some of you have been insured with the same carrier for 10, maybe 20 years, and all of a sudden you're hit with a non-renewal for the first time over the course of the last few years. Certainly new for a lot of you. And then, of course, our underwriting appetites have changed and frankly continue to change, meaning insurance carriers get to determine what their underwriting guidelines are. Typically, they are based on common sense. We know that there's dangerous situations at any aging property, but also it can be determined based on losses that particular insurance company has seen in the past. and something that they want to avoid in the future. So we've always seen underwriting appetites change, and certainly can be different from one insurance company to the next. But I would say in the last few years, we've seen more aggressive appetites changing, and more questions are asked of our homeowners associations and of us insurance professionals than we've ever seen before. Next slide, please, Connor. So, taking all of the history that Kevin shared with you and a little bit of what I shared with you on the last slide, this has led to a lot of associations finding themselves for the first time ever in many cases in what we call the surplus lines or excess market. And so I just want to make clear that, and I'm assuming here, Amy, who mentioned again that 8 times premium increase that they experienced last year. I'm going to assume that it wasn't your standard, State Farm carrier or Farmers carrier that suddenly increased premium from $73,000 to $583,000, because frankly, it's really hard to even be able to do that for a number of reasons. I won't get into Proposition 103, but insurance carriers, California admitted insurance carriers, their hands are tied. They can't really offer a substantial premium increase like the one that Amy's seen. So typically when you see something this substantial, it means that you've gone from a California admitted insurance carrier. Those are kind of your household names. We all know them and love them. State Farm, Farmers, Travelers, Philadelphia, into the surplus lines market, which I refer to as kind of the wild, wild west. Their insurance premiums can basically kind of be whatever they want them to be. And that's where we see those substantial, 800% insurance increases. So really quickly, I just want to go over, and I know this might be a review for some of you, the difference between California admitted insurance carriers and the surplus lines insurance carriers, the wild, wild west, if you will. California admitted insurance carriers have to adhere to the Department of Insurance and the requirements that they pose. So their premiums have to be approved by the Department of Insurance. Their policy forms have to be approved. You've got this third party, the Department of Insurance for the state of California, looking over everything that those California admitted insurance companies are doing. And in addition, there is the California Insurance Guarantee Association, I refer to it as CIGA, which basically states that if a California admitted insurance company goes insolvent at the time of a claim, usually this would be in some type of substantial loss, that there is this guarantee fund of up to $500,000 that will help your property or association at the time. I just want to play devil's advocate here. If we're talking about a major loss to a homeowners association, although I love a guarantee, $500,000 probably isn't going to do too much for an association that's seeing substantial damage, but who doesn't love a guarantee? Versus the surplus lines insurance carriers, they have the freedom to rate as they choose, wild, wild west. There isn't that consumer protection through the CIGA fund. They are typically absolutely more expensive. We've seen this. And just some silver lining, they're made up of some of the most well-reserved insurance companies. Some of these insurance companies have been around since almost, I'm exaggerating here, but the existence of insurance itself. I always do a show of hands who's heard of Lloyd's of London. Lloyd's of London is a household name. They are absolutely part of the surplus lines market. And I also want to say that the surplus lines market may be new or different for some of you, but for insurance professionals, this isn't new at all. We've always been able to place our hard to place risks in the surplus lines market. It's just unfortunately with the appetites of insurance carriers changing, more of our properties have had to enter the surplus lines market than before. So I would assume that that's the substantial increases that some of you are seeing. Next slide. So how can we stay in the California admitted market? Because we want that. We as insurance professionals want that for you. Legally, we need to keep you in the admitted California market if we can. And obviously you want to pay the premiums of the California admitted market versus the surplus lines. And so I put together this little chart so that we can look and see what are the things that can keep us in the California admitted market. There are some things that you and your association can control, and there's some things that you can't, and there's a little bit of overlap. So some of the things that you can't control, the size of your association. You know, Kevin mentioned that newer associations, newer properties typically have, you know, fire suppression systems and all the bells and whistles that insurance companies want to see. However, this can be very frustrating because some of those newer associations that have all the bells and whistles also exceed the size restrictions for some of these California admitted insurance companies. So some of these companies have said, you know what, we don't want to insure anything over $75 million in value or $100 million in value. That can be really frustrating when you know that you hit all of the requirements in every other section of your property. The year that you were built, obviously.
Yeah, I just took a mean ass shit in Chipotle. Holding this shit for almost 15 hours.
Okay.
We're
I'm going
good
to keep
now.
going. The year that you were built, obviously you can't change the year in which your property was built, and your fire risk rating. Unfortunately, the fire maps are what they are. Insurance companies are looking to those. And although we've tried, and I'm looking here in the room today, I'm sure my fellow insurance professionals have tried to convince insurance companies to consider a different fire rating for some of our properties. I have yet to see any movement there. And then on the side of which you can control your maintenance and your repair, even if you are an aging community, obviously you can't change the year you were built. You can certainly enhance your maintenance and make sure that you're doing what you can there. In this kind of middle section here, some things that you think you may not be able to control, but there is some level of control. Claims history, we'll talk a little bit about that. And then the type of electrical panels. And I know a lot of you are probably rolling your eyes at that because electrical panels have become kind of a hot topic, pun intended, in our insurance industry. Next slide, please. So let's stay focused on some of the things that we can control. The loss history. Again, we want to avoid losses. This is going to help, one, stay insured, but two, avoid, out-of-pocket expenses. So we certainly want to avoid losses and getting those onto your loss history, because as we go around shopping insurance for you, loss history is a huge factor that insurance companies are taking into consideration. Dangerous conditions at the association, including older infrastructure. A very rude awakening, if you will, a heartbreaking awakening was, of course, Champlain Towers out of Florida. We saw that there were very dangerous conditions at the property that had not been addressed. So we want to make sure that we're doing everything we can to maintain those aging infrastructures. Open claims. If you've got an open claim and it's coming up to renewal time, this is a time that you really want to work with your community manager and your insurance professional to make sure that those claims are getting closed as quickly as possible. Lack of maintenance. Again, insurance companies are doing their own survey of the property, and they're paying very close attention to any lack of maintenance. Hey, you've got a roof that's 20 years old, looking at your reserve study, it's only a 20-year roof. What are your plans for replacing it? Again, this big ticket item, the electrical panels, I call them four-letter words in the insurance industry. If you've got Zinsco, Federal Pacific, Stablock, Challenger, there's a few other names in there, the list goes on. These are considered dangerous electrical panels that need to be replaced as soon as humanly possible, and hopefully before your insurance renewal, so you have more options of insurance. Next slide, please, Connor. All right, so we want to avoid future losses, and really we want to help them, insurance companies, understand the past losses. So I always tell my folks internally, we want to make sure that we're telling the story to insurance companies. If you've got loss history and you've got a few claims on there, we're really paying closer attention to the patterns on those claims. And we're hoping that we can give some substantial stories to these insurance companies so that they understand that. So we're paying attention to the patterns in our loss history. And I should say the insurance companies are paying close attention to those patterns. So even if you have small, let's say 3 small water claims over the course of 5 years, it's not necessarily about the small claim being an issue. It's the pattern that they're seeing. Okay, we see that there's 3 very similar water claims in the course of 3 or 5 years. What happened and what's being done to mitigate that from happening again? So if you've done any major replacement to your pipes, as Kevin mentioned, these are stories that we want to bring back to the insurance carrier. And then maintenance, what's being done, what has already been done to avoid losses. Please don't think because you have a loss on your history that you've got this scarlet letter and you're uninsurable. It's really about working with your professional, your insurance professional, to make sure that we have an understanding of what happened and what you're doing as an association to prevent it from happening again. Next slide. So now more than ever, you really want to work with an HOA insurance specialist. So truly someone that specializes in homeowners association, understands the Davis-Sterling laws, how to read your governing documents, how to work with board of directors, how all of this kind of functions. I always talk about red flags. Major red flag if you contact an insurance person and they don't know what the Davis-Sterling is, if they don't ask for a copy of your governing documents, you are certainly in better hands working with a professional that understands this particular industry. Also, because more of our clients are having to turn to the surplus lines market, you want to work with insurance professionals that have an understanding of the surplus lines policies. And I always say, every insurance policy is only as strong as its endorsements or as weak as its exclusions. So you want to work with an insurance professional that knows what to look for in those unique surplus lines policies and make sure that you're still, as an association, adhering to best practice, Davis-Sterling, and your governing documents. Also, we as insurance professionals are following trends. What insurance companies are exiting the market? What insurance companies are coming back to the California market? And if they're coming back to the market, what is it that they're looking for in an association? Also, policy language expertise. Obviously, we need to pass the education on to you, the homeowners, the board members, your community managers, so that you have an understanding of what's covered before a loss even happens. Last slide. All right, and just so you know, we are very aware of the history that led us to where we are today, what we call the hard insurance market. However, your dedicated insurance providers are working harder than ever to find that coverage for you. We are having to turn to unique policy products, and we're making sure that we're still adhering to all of the requirements. Making sure that your insurance professional is being transparent and sharing all of this with you, and certainly not a week before your renewal, but well before the renewal date. So you have an idea of what's going on with your policy. Are you being non-renewed? If you are, who are the players in the open market? And then sticking with a specialist that's watching those fire maps change as they change, following the state guidelines and the news that's coming out from the Department of Insurance. They've made a lot of promises. We've made a lot of headway talking to the Department of Insurance and helping them understand that homeowners associations require a commercial insurance policy. I will be honest, for a long time, legislators and the Department of Insurance really didn't seem to have a clear understanding of that. So rest assured, we're working hard on that. We're collaborating with one another. Fellow insurance providers, friendly competition, if you will, including the insurance providers in this room today. We're all working collaboratively to try to find solutions for you guys. You want to work with someone that has access to many insurance companies, and understanding, who's still in the market and who's re-entering. The silver lining for me, and I agree, Kevin, I think, unfortunately in this hard market, a little bit of doom and gloom for the last few years. But the silver lining is that we are seeing new insurance companies enter the market. Sometimes it's those carriers that just weren't in California. Maybe they were specializing in hurricanes, East Coast, whatever that might be. And so, just like with any problem comes solutions. You just need to work with someone that's really paying close attention. That's it for me. Thank you.
Okay, perfect. Thank you very much, Charlotte. That's the end of our first general session of presentations. We're going to go ahead and head into our breakout rooms.
So let's go ahead, Christy. You're next up. So I'll give it to you now.
All right, thanks. Okay, hello everybody. So for my portion of today's meeting, I'll be talking about earthquake risk management and strategies for homeowners associations. And to kind of kick things off, next slide, Connor, I wanted to give a couple of statistics. I think that in today's times, I think we really focus on a certain type of disaster sort of risk, which is wildfire. And I think the earthquake, even though it's the OG kind of disaster situation that we've had in California, I think it's really been pushed to the side. So I think it's good to remember just some things that if you've lived in California long enough, you probably know this already, but it's just a good reminder. And when I was preparing for this, I found some pretty interesting information. First, we've got 15,000 known faults in the state of California. And of those 15,000 faults, more than 500 of them are categorized as active, meaning an earthquake event could happen at any time, any place in one of these faults, and it could be any level magnitude. And most Californians live within 30 miles of an active fault. Unless you're like me, I live in Santa Rosa, and I'm like a half a mile from an active fault. So some people might be closer, some might be farther, but the average is about 30 miles to an active fault. And so I think that means that earthquake still has a place at the table for boards to be talking about, having conversations around, educating themselves, educating their membership, and coming up with some great ideas that can be helpful for their entire communities. Next slide. On this next slide, what you're going to see here is a map of the Greater Bay Area with colored lines. These are faults. You might recognize the names of some of these, and they vary in color from yellow all the way up to almost red. The yellow fault lines are those that have a less likely probability for activity. And then we have one on here, which is the Rogers Creek Fault up north. This is the one that actually does run through Santa Rosa, and it's more on the red side. So the probability of that fault having some activity is a lot higher. And what this slide tells us is that there's a 63% probability for one or more magnitude earthquake of 6.7 or greater through 2036. I'm not really sure why they stopped at 2036. I'm sure that it goes beyond that, but that is a pretty high number. So I think that we need to remember that, and we need to keep that in our minds, because for some of your community members, earthquake is something that's really worrisome for them, and we want to acknowledge that, and we want to remember where we live. Okay, next slide. So this next slide is showing you a picture of an association that suffered property damage, building damage from an earthquake, because they happen to be in a high liquefaction area, which plays a very big part in how much damage can potentially happen to a building. When you couple shaking from an active fault going off with a high liquid content in the soil, it can really create the perfect storm for a large amount of property damage and potentially loss of life. So understanding what is the geology underneath your community and what the makeup of your soil is pretty important information to know when thinking about earthquake risk management and kind of what your association wants to do. You should be knowing this information, what you're sitting on top of. Next slide. So that's going to lead us into what options do HOAs really have when it comes to the peril of earthquake. It's excluded on your hazard insurance policies, along with other things, including flood. So really, there's only a few options that are out there. And the first is to just buy a master earthquake policy for the association. There isn't anything that can really replace a master insurance policy. It's multiple millions of dollars of coverage, and you can't, associations really don't have the ability to save enough money over time to equal the amount of insurance that they can purchase with a policy. So it's always good to remember that a master insurance policy is the best thing that you can do for your association. And the cost of the insurance policy is based on a lot of different factors. Obviously, the amount of coverage that you would be purchasing is going to factor into the cost. And what's interesting about earthquake insurance is that it can be purchased at an amount that's less than you would buy on your hazard insurance policy. So it's common that, let's take a hypothetical association. It has $20 million of hazard insurance, but maybe only has a $5 million earthquake policy. So that is something that we do see, and the amount of coverage is going to factor into the cost. The deductible amount obviously is going to factor into the cost. The higher the deductible, the lower the premium, vice versa. The lower the deductible, the higher the premium. So where you decide to set that is going to dictate the cost of your policy. And then the carriers that do offer earthquake insurance, they want to know what the total insurable value is. They may not insure you for that amount. They may be giving you a quote for $5 million, but what it would actually cost to completely rebuild your association is an important number to them. So they take that figure and that's factored in as well. And then earthquake carriers do use modeling software. They plug in the characteristics of your association, coupled with fault zones and shaking probability and liquefaction and building characteristics. And this model helps them to understand what the potential amount of damage that could happen. So these are many of the things that determine the cost of an insurance policy. And speaking of the cost, master earthquake insurance, it's not cheap. We know that, and it's rising. It continues to go up. And in this time when a lot of associations are struggling just to maintain their hazard insurance, or they're paying 8 times the amount of insurance for their hazard insurance, a lot of times the earthquake insurance just gets kind of pushed to the side. And so that's a big reason why a lot of associations don't have any earthquake insurance, is just the cost. So, I get a lot of boards who ask me how many associations have earthquake insurance, and it's really hard for us to know that number, but it's suggested that probably between 10 and 15% of associations have an earthquake policy in force, which is pretty low. That means there's a lot of exposure out there. You have a lot of associations where the association is going to have to pick up the cost in full to repair once an earthquake has done damage to their association. Next slide. So the next option is really, if we don't purchase it for ourselves, or even if we do, individual unit owners can also purchase insurance for themselves. There are multiple carriers that will offer insurance out there for the individual unit owners, but I don't have enough time to talk about them all. So I'm going to focus in on a newish program, which is the Modus Insurance Program. It was introduced in 2017, and this is a program that is tailor-made for each association, and it's individualized based on the association's unique needs. It's an opt-in program, the association, the board has to make a move and choose to opt in and pay an annual fee to opt into the program. Once that has been done, then that opens up for individual unit owners to choose whether they want to or not to buy an insurance policy from the Modus insurance program. And it's a very large loss assessment. It's basically a loss assessment policy. And you can add additional coverages if you want to, or you can just have the loss assessment portion. It's a great program in that it offers more coverage, and it includes components that you don't see being included with the California Earthquake Authority, which is where a lot of people end up buying their earthquake insurance from. So Connor, go to the next slide. This is some marketing material directly from the Modus program. And you'll see two columns here. One shows the Modus specialty policy and the coverages that are included with that. And then it's comparing it to the California Earthquake Authority. And usually when people see this, they're pretty surprised to see that things like the common area, if there's only damage in the common area and there's a special assessment given out to everyone in the association, your California Earthquake Authority policy isn't going to cover that. Or any parking structures not covered with CEA. So having your association make the choice and decision to opt into this program really does open up a whole new insurance policy for the individuals to take into consideration. Next slide, Connor. So these are the insurance carriers that do participate with Modus. These are the same carriers that are also offering master earthquake insurance. So they've partnered together to create this really fantastic policy, and I would encourage you all to, on your own time, take a look at this and check it out. The Modus has a great website. They have a lot of videos on YouTube. You can just search them up on YouTube, and they explain how the program works. And it's really great. It's a really great program for your association. All right, next slide. All right, so there are some additional things that associations can do, that boards can do to help mitigate earthquake risk and give some strategies. The first would be to develop a risk management plan or a disaster preparedness plan. And these are fantastic. They create a safe environment for everyone, and they can include a lot of information. They can include a site plan, specifically for earthquake, maybe point out where gas shutoff valves are so that if there's a gas leak, somebody knows how to turn off the gas to the buildings to protect them from fire loss. They can include evacuation routes, centralized meeting points for after a disaster has happened. And it doesn't have to just be for earthquake, it can also be for wildfire. So these are fantastic things to make available to your community. Also, you should be taking a look at your construction and improving that and enhancing building features that would make those buildings be vulnerable in an earthquake. So the idea behind doing that is really to prevent loss of life, but also to prevent property damage. You can hire experts to come out and assess your buildings, let you know about retrofitting, let you know where weaknesses lie, and help you to make better decisions and choices about, protecting everyone living within the community. And then enhance community preparedness. Educate your residents on earthquake safety measures, bombard them with information. If you've got a website or a community Facebook page, you put out a newsletter, put information in there for people, put your preparedness plan in there as very often, because you'll have unit owners moving in and moving out of the community. So you don't want to just put that information out there once and be done. You should be putting it out there at least quarterly as a reminder to everybody. Next slide. And as I come to the end of my portion for today, I compiled a list of helpful websites for the community. The first one is the California Residential Mitigation Program. This is an excellent source regarding grants for retrofitting. I would check that website out. The Modus Insurance website is listed on here. Go check out more information about them. California Earthquake Authority, where I don't actually advocate for that insurance policy, there is a lot of good information on there that just can better educate you around earthquake science. So it's great for information. The United States Geologic Survey, just a wealth of information on there. There's so much information on earthquake, you'll never wish you knew about it. You can see real-time activity, earthquake activity all over the world in your area. It's just fantastic. Earthquake.ca.gov. Very interesting. I went on this website and discovered that there's an app for your smartphone called the MyShake app, which was created as an early warning system for earthquakes. It's intended to try to give you a couple of extra seconds. I know it doesn't sound like a lot, but in an earthquake, seconds can mean the difference between a life lost or not. So you can go to that website. You can also go on your smartphone to your apps store and download the MyShake app. And then last but not least, this is a website that was put out by the state of California, specifically around earthquake information, just another wealth of information. So these are all fantastic to better educate your communities. And then check with your management companies on their websites, or even just with your property manager. A lot of them have already put really useful information about what you can and what you should include in a disaster preparedness plan. And if you haven't created one, potentially get a committee together and create this disaster preparedness plan and put that out there for everybody to make your community a safer place to be. And with that, I'll say thank you so much. And that's the end for me.
Okay, great. Thank you, Christy. We're going to head over to Bridget for our last general session presentation.
Okay, hello everyone. Last but not least, hope you're still with me. I won't make you create a policy, I can tell you that. So I'm going to be talking about the difference between an umbrella policy and an excess liability policy. Connor, you want to advance? I know most people have heard those terms and they use them interchangeably, but they're similar, but they're very different. I prefer umbrella policies. There's two key differences on an umbrella that you'll find with an excess liability policy. So the umbrella policy will offer much broader coverage. That means that if something excluded on the primary, like your underlying policy, your GL policy, if it's excluded there, it can be picked up under your umbrella policy. And a lot of times you'll see that on personal injury claims, defamation, libel, slander, those types of coverage. The second thing it does, it increases your limits, but unlike the excess liability, it goes across multiple policies. So you have maybe seen it, you'll get a quote and you'll say 1 million GL, and then you'll see 6 million under your higher non-owned auto and 6 million under your general liability or your employer liabilities. So if I had to choose between the two types of policies, umbrella is my preference. Next, please. Next slide there. Now the excess liability policy, it is similar to the umbrella where it will extend coverage, but in a very different way. So with an umbrella, you're getting the same coverage as your underlying policy, just higher limits. So whatever terms and conditions that exist on the underlying policy will be true for your excess liability policy. It does not expand the coverage to any additional types of risk. It simply increases the dollar amount. The second thing that's different about excess liability policies, they can be policy specific. I work with a carrier, and I'm sure Christy and everyone else here has heard of USLI. And when you get their excess liability policy, it can only be placed over their policy. So you cannot put a USLI policy over another carrier. It's very policy specific. and it does not offer what we call drop-down coverage. So if something is excluded on your GL policy, coverage will not be given to you or your community on that excess policy. And that's a huge difference. Next, please. So I've already kind of talked about the drop-down provision, which is the first thing I look for. So when I'm looking to bind coverage or quote coverage, especially if I'm not the incumbent broker, this is a really important thing that most good agents will look at. But the other difference is what we call a self-insured retention, or you might hear or think of the word deductible. Because the umbrella could pick up coverage that's not offered by an underlying policy, you could pay a deductible. But the excess policies, since they don't have that feature, you don't have to worry about that. The excess policy is what we like to call follow form, meaning they adhere precisely to the terms of the underlying policy, which I previously stated. Cost, obviously, an umbrella policy is going to cost more than an excess liability because the umbrella is covering more things, and the carriers do it for a certain reason. They're trying to limit their exposure, so they're excluding certain things from your policy. But if those things that's being excluded and you think your community needs that, if your agent tells you, if your attorney tells you you need that coverage, then that's when you need to look to your umbrella policy. So how do you decide whether you get an umbrella or an excess policy? It depends on what your concerns are. So if your concern is you have known risks, but you want a higher limit, excess is fine. But if you need broader coverage and you have concerns about other potential liabilities that's not maybe common for most HOAs, then you definitely want to make sure your agent gets you an umbrella policy. Next, please. So why do you need the coverage? Well, obviously, common area exposure. I don't need to talk about this. Board protection. Again, an umbrella policy can extend coverage for directors that might not be there on an excess liability policy. Contractors, we hire people. I was board president for 12 years. We hire contractors to come in and do work for us. We're not experts, but we have had a few claims due to incidents with our contractors. Again, you're going to want to know if you want an excess policy or an umbrella. Budget. We don't have the ability to raise funds like regular corporations. This is our piggy bank right here. We know special assessments can take 60, 90, 120 days. You don't have 60, 90, 120 days. So having the right type of extended coverage is going to be key depending on your association and your funds. And even if you have the funds, do you really want to spend the funds on insurance? Multiple property exposure. The more homes or condos you have, the more liability you have. So that's another factor that we look at as insurance agents. Connor, next slide, please. So how much? Well, that depends. The Davis Sterling gives us clear guidelines on the general liability, but they don't give us clear guidelines when it comes to this extended coverage. My rule of thumb, and it's very community specific, but this is what I use. If it's under 50 units, I'll say we'll look at 2 to 3 million, up to 100, 5 million, up to 100, 10 million or more. High value communities, they have much higher risk. Number 2 shows what those risks are. I have one community that I insure. They have 7 pools. They have 3 fitness centers. They got 10 parks, and each one of those parks have these humongous play structures. So that's going to increase your liability. I have 2 waterfront properties. They have a lake. They have docks. There's liability there. Obviously, golf courses. Don't need to talk about that. So these factors for a lot of the communities here, and there are a lot of different communities being represented, it may not be relevant, and you might be okay with just an excess liability policy. But for some of these, what I call high value communities, you might need to consider looking at getting an umbrella carrier. Next one, please. The coverage, you know, you really have to look at your talk with your agent, talk with your attorney, look at the CCNRs. But I can tell you the ones that I have the most in-depth conversations with are these high-rise communities. Those historical properties and these ones like the Senior Plus communities, those are the ones that I come across the most. You know, they got a social committee and they have, you know, Halloween, and they want to let people come in and trick or treat, and they want to have a farmer's market, and then they have bingo every Thursday and bunko every Friday. All those people coming and going, that represents exposure. If they sell drinks, and there's another policy you would need, but if they're offering liquor, you know, there's a liquor liability issue and concern. So it's very community specific. Every agent here is very, very well versed on these types of policies. But the idea is to kind of make you aware. You don't have to become a liability expert. I'm just here to make you aware of the considerations and things that you need to be aware of that you may need to ask and have not asked your agent. Next, please. So I was involved in a situation one summer. A 12-year-old boy was playing in the pool. His parents were there. For those people who had unaccompanied minors, he was not an unaccompanied minor. But the depth markers on the side of the pool were faded, and there was decorative plants. I don't know why they had decorative plants there, and they did have a lifeguard. They allowed, you know, they have swim meets, and they have, you know, the regular community guests. Well, he dove into the shallow end, did not note the depth, and he was hurt. And the HOA was sued for $5.7 million. 1.2 was for his medical expenses. 3.8 million was reserved for future medical expenses, and the family was suing for $700,000 for pain and suffering. Next slide. So what did the carrier do? They had the underlying 1 million, exhausted. Then the HOA's 5 million umbrella, and I do stress it was an umbrella. Had they had an excess follow form policy, the board would have been paying this extra $4.7 million judgment. Without that, they would have had to levy a special assessment on all the owners. Even if it's a community of 100 homes, that's $47,000 per home. Who can afford that? They wouldn't have been able to do that. So I don't know, bankruptcy could have been an issue. So these policies are very important. And even in this situation, the board was facing some liability. Now they have their D&O coverage and they had defense costs, but they ignored the manager, they ignored their attorney, and they ignored me. So not surprised this incident happened. Next slide. Connor? Okay. So what I really want to focus here on is property value protection. And you all know that you have to maintain adequate levels of insurance. But with the market being what it is today, a lot of HOAs aren't maintaining the levels that they need. I had an HOA that needed 70 million in coverage. They only found 30. They put a $50,000 per door deductible, and that created numerous lawsuits, and they did away with their excess liability coverage. Now, this is 369 units. They couldn't sell any units. They couldn't refi any units. Mortgage companies were very, very unhappy. And the board had to go back and buy additional coverage in addition to fending off lawsuits, because one of the owners was an attorney and he was an investor, and he had just refurbished 3 units in this community. So not only did they have the problem of the insurance, but then they also had the potential lawsuits. And we all know when residents are unhappy, the first thing they're going to do is they're going to sue. So again, here, having an umbrella policy, not an excess, having an umbrella policy was crucial in helping the board defend the lawsuits. So I think everyone can see how important it is to have this type of coverage. And I hope you understand the difference between the two types of coverage, and that you now have enough knowledge to go back and have discussions with your boards. For those who don't have all their board members here, and their managers and their homeowners. The other places coming up is with the ZenSco panels. We have, everyone is having these panel issues, and we've had some boards. We had one board that had refurbished ZenSco panels, and I want to say to everyone, there's no such thing as a refurbished ZenSco panel. And there was a fire, and luckily only one unit was damaged and the other one smoke damage, and no one was hurt. But you know, this type of coverage is very inexpensive considering the amount of coverage you get. So if you don't have an excess or an umbrella policy, I would definitely recommend you go and talk to your agent about the cost of getting it.
Great. Thank you very much, Bridget. Connor's going to take a couple minutes to spread it. A good break there with with all of our sponsors. Thank you so much to the sponsors. We really appreciate it. I want to say thank you to all of the ECHO members for coming here today and supporting our ongoing ECHO webinars. For those of you who are not ECHO webinar or ECHO members, please consider becoming a member of ECHO and supporting HOA boards throughout the country. To join, simply go to www.echo-ca.org and click on the membership tab. For ECHO members, thank you so much for supporting us, and please invite your friends, boards, and especially management firms and vendors to join ECHO. A simple invitation is often all it takes to encourage someone to be a member. If you would like to become more involved with ECHO, please consider joining our ECHO Volunteer Corps. The Volunteer Corps is made up of many people that have been willing to promote and help ECHO at events and writing articles, editing, and doing some basic data entry for us. So we could use your support, and let us know. Just send me an email at dzapponi@echo-ca.org, and we can talk about your ideas. Now for our other announcements. The ECHO HOA University has an educational program focused on HOA board preparedness. The core curriculum of 10 courses is designed for high-quality training and is available to HOA boards and interested homeowners and professionals, frankly, to anyone. Your participation in this program will earn you a certificate of HOA board member preparedness. We have a fresh new crop of graduates, and we will be recognizing them on June 7th, this Saturday. The courses are offered live online, and some of them are on demand, recorded and on demand. If you or someone you know wants to enroll in the certification program, please contact Connor. He'll set you up. His email address is on the bottom of the screen. We have 10 courses, and I counted the hours the other day. It's 29 and a half hours. So be prepared. It is a fairly comprehensive program, and you will be able to take it over a 3-year term. So we hope that you'll consider it. And other board members. The third quarter panels, resource panels are in Sacramento. We have a resource panel coming up on August 5th, landscaping, and then the ECHO Club at Rossmore, or TCAR, will have a meeting on August 6th, and they will be going over reserve studies specifically for the Rossmore, but I think anyone is welcome, and you can hear about reserve studies there. The East Bay Resource Panel is August 7th. and it's going to be the budget season toolbox. The Los Angeles Resource Panel is August 12th. I don't have the topic. And Orange County is August 13th. Don't have that topic either. And then San Diego as well. I need to get those topics. I don't have the topics. And San Diego is August 14th. So if you're down in the Southern California area, we are growing these panels, and in particular, Los Angeles is growing fairly nicely, as is Orange County. We also have 3 larger in-person events planned for this year with multiple speakers and about 18 to 24 different tabletop exhibitors. Register for our first event on June 7th. That's just right around the corner. So if you get hurry up and sign up for that one. We have, I believe we're close to 150 to 160 people attending that one. That's in person. I think it's worth your time. It's worth your while. The theme of that event is who's responsible? And that's a pretty good topic for those of you that attended today. When you have a water leak, you have an earthquake, you have other issues that are happening, who's responsible for the damages that occur? In Northern California, we have the Northern California Educational Seminar on the 7th. It's the Saturday. October 10th, we have the Southern California Educational Seminar. Then we have our legislative update and NorCal seminar on November 15th. That's a little ways away, but that'll be right after the session, the legislative session, and we'll be able to give you all the new laws. And thank you to everyone here for presenting their information to us today. And of course, thanks to all of you for attending today and making this a successful event. ECHO appreciates your investment in education to foster a better quality of life in HOA communities, which is our mission.